Hey traders, just wanted to make a quick video to share with you my trade on SOFI using the wheel strategy. This is actually my second recording. The first one I made, I don't know what happened, but I went through the entire episode and thought it was recording, but it wasn't recording. So I'm going to have to re-record. So this is my second time through. Hopefully it's a little bit better than the first one, but let me just jump right in. So if you're new to options trading, one of the things that I teach is the wheel strategy, and it's using the two techniques that I love the most. Number one, selling a cash secure put for security, and then number two, selling a covered call. Now, if you're not familiar with selling a cash secure put, give me 30 seconds and I'll explain it real quick. When I sell a cash secure put option, I'm telling the stock market at large that I'm willing to buy a stock at a certain price. Now, if you look at your screen, I'm showing SOFI. This is a daily chart for SOFI. You can see it's currently trading right around $25.25. Now, when I make my offer to the market, I'm going to tell the market, hey, I'm willing to buy 100 shares of SOFI for something underneath what it's currently trading for. So let's use $22.50. So it's at $25.27, but I'm going to tell the market I'm willing to buy 100 shares for $22.50, and my offer is good for the next week. So my offer's out there. If anybody wants to take me up on it, let's connect and I'll sell you my cash secure put option. Now, the price that I picked at $22.50, that's known as the strike price. And that period that I picked, right? So I've got a I got a 1 week expiration. That's known as the expiration period. And on that last day, so today's Friday the 21st, next week would be Friday the 28th. That would be the expiration date. So anytime between now and the expiration date, I'm willing to buy 100 shares. And I'll pay $22.50 for them. Now, if any point in time the share price dips to my strike price or just below during this period that I picked, this expiration period, then I'm obligated to buy those shares. Now, what does that mean? That means I need to have $22.50 per share, or because it's 100 shares, $2,250 reserved in my brokerage account, so that if somebody takes me up on this offer, they exercise the option, then I can take the money that I have reserved and I'll purchase those shares and I'll pay $22.50. Now that's a discount off the current price of just over $25. So that's why I would make this trade, right? So I'm getting the shares I want. I like SOFI, the company. I'm going to get the shares I want, but I'm not going to pay $25 per share. I'm going to pay $22.50. That's what my offer is. And my offer is good for the week. Now, I'm tying up, or I'm reserving $2,250 to make my offer good, right? So as soon as somebody wants to sell me their shares, that's called getting the shares assigned to me. I'll use that money that I reserved to purchase those shares. Now, in return for doing that, because I'm going to tie up, a little bit over $2,000, I'm going to tie that money up. And for me, I need to get something out of that, right? So whether or not somebody takes me up on my offer and actually buys the share or sells their shares to me, I want something in return, and that's what's known as getting a premium. So I'm going to get paid a premium, and it's based off of value per share. So let's say the premium is 10 cents. Well, for those 100 shares, it'd be 10 cents times 100, or I would get a premium payment of $10 for keeping my money reserved for that 1 week period. So that's what selling a cash secure put is all about. Now, if at the end of the expiration period, as I mentioned, the market price, the current market price dips down to my strike price, the $22.50 or below, well, then I'll purchase the shares. For example, if the share price drops to $22, I'm going to buy the 100 shares, but I'm going to pay $22.50, even though the market price is $22, because I guaranteed that I'd buy them at $22.50. But if at the end of the week, that end of the period, the period that I made it good for, if the market price dips down but never reaches the $22.50 mark, then the option contract expires worthless. That offer that I made, it's null and void, no longer good, but I still keep the premium payment that I received. Remember that 10 cents per share, that $10 that I received up front? I keep that money. That's mine to keep forever. It doesn't go away. But if I do get the shares assigned, then I'll purchase those shares, and now, as part of the wheel strategy, I can turn around and use those same shares to sell a covered call. Right? So I would now own 100 shares of SOFI in my trading account. I can now use those same shares and sell them to the open market using a covered call. So this is the wheel strategy, right? So I get into it by selling a cash secure put. If the shares get assigned to me, I can immediately turn around and use those same shares to sell a covered call. And I would pick a strike price, the price that I'm willing to sell them for, above what I currently paid for them. So if I get the shares assigned to me at $22.50 and I own 100 shares and I turn around and sell a covered call, well, I'm going to set my strike price, or the price that I want to sell those shares, at either $22.50 or maybe $23 or $23.50. It just depends on where the current market price is going to, right? So if it's trending higher, I'm going to pick a strike price that's higher. That way I'll get paid a premium. Plus I'll get some appreciation from the share price. Now, one of the good things that I look for when selling a covered call or a cash secure put is I try to determine what's a good entry point. So there's certain times when the stock price or the share price that I'm interested in is moving higher and lower, it's more beneficial for me to sell a cash secure put or a covered call at certain times. So let's go ahead and take a look at the chart. You can see it here. I've got a daily chart up for SOFI, and it goes back to about the middle of August. So I've got roughly, 3 months up on the screen. And we can see that the share price has been bouncing in between the support and resistance levels. Now, if you're not familiar with support and resistance levels, I've got some other videos that you can take a reference to or that you can look at. But basically, let me explain. As the share price dips down and reaches this support level, it tends to bounce off of that and start moving higher, right? So there's increased interest and buying demand, and that forces the price to go higher. As the demand goes up and people start buying shares, then the price will tend to go up. And as it reaches a certain level, known as the resistance, so as it goes up, it reaches a resistance level, there tends to be a market sell-off, so people start taking profits. There's less interest, more people are selling the shares, and as the demand goes down, well, then the price tends to go down. And you can see that this price for SOFI has been trading in this range in between the support level and the resistance level, right? So here we see it's at the support level. It goes up a little, comes back down, hits the support level, starts moving up, starts getting close to the resistance, starts moving down again. And we can see this trend repeating over and over again. So it's getting down below, there's more interest, people buy shares, the stock price moves up, and then people start selling their shares, taking profit, so there's less demand and the share price drops down. And we can see that here marked between the support and resistance level. Now, you can see a blue cloud or a blue shadow associated with these candlesticks, and that's known as the Bollinger Bands. It's a mathematical financial representation of the current share price relative to the average price. Now, inside of this blue cloud, you'll see this blue line. That's a 20-day moving average. And the upper red line and the lower green line of the Bollinger Band, this clouded area, gives you a standard deviation of how far the share price is away from the average price. So as the average price moves higher and higher, and eventually, you can see here, it exceeds the standard deviation, or the upper bound of the Bollinger Band, that puts increased pressure for the price to come down and for a sell-off, and so the price will tend to move lower. Now, the opposite also holds true. So as the share price moves below the bottom edge of the Bollinger Band, as we can see here today on Friday the 21st, there's some pressure for the share price to move up now and move back up to that average. So that's what makes a good indicator, or one of the good indicators for selling a cash secure put, right? So we're below the average. We've actually gone below the Bollinger Band. And so now there's going to be some increased pressure for the share price to go higher. So if I'm going to pick a strike price for my cash secure put, I'm going to pick something that's below the support level, because I have a higher probability of that option expiring worthless, because there's pressure for the share price to move back up. So let's go ahead and jump over to my brokerage account and take a look at the option chain to see what options are available. Again, I'm looking at a support level right around $24.43. So I want to find an option available with a 1 week expiration that has a strike price below where it's currently below the current support level. So something below the $24 1 week out. Let's go ahead and take a look. So I brought up my trading platform on my brokerage account, and we're taking a look at SOFI Technologies. You can see it's currently trading at $25.31. So I'm going to press trade SOFI options. And I'm interested in selling a cash secure put, and I'm looking at a 1-week expiration. So I'm going to go out to November the 28th, which is 7 days away. And we're going to start looking at the different options that are available. So as I move down, we could see the current share price here, $25.32. And I'm going to be looking at strike prices somewhat below this. Now, as I mentioned, I've already recorded this video once. And so I've actually executed the trade. You could see it here at $22.50 as my strike price. So let's go ahead and take a look at this option. So it's $22.50 is my strike price. It has a 13 delta, which means for every dollar that the share price moves, this option price will move 13 cents. Now, the other shorthand that us option traders use, we use it as a potential or probability indicator of the market price actually meeting the strike price and for the option to be executed. So what that, in layman's terms, what that really means in shorthand is that there's a 13% chance that the market price will actually reach my strike price and the option will get executed. So if there's a 13% chance that it will get executed, there's an 87% chance that it won't get executed, in which case the option would expire worthless and I would end up keeping my premium payment and not being obligated to buy those shares. Now we can see there's plenty of open interest, 455, and there's decent volume, 951. Now the bid and ask right now is currently 19 cents and 24 cents. I was actually able to sell the option with a higher premium value earlier, and that's because, market conditions at the time were more favorable. But we'll go ahead and use the numbers that I got for my actual trade. Let's go ahead and take a look at SOFI using my cash secure put analyzer. Well, today's November the 21st, and we're talking about symbol SOFI. And I'm using an expiration date of November the 28th, so 1 week out of 2025. Now I used the strike price of $22.50 and a premium value of 31 cents per share. Now SOFI is currently trading at just over $25 per share. I'm interested in selling one contract, which is equal to 100 shares. So for every contract, there's 100 shares. And by picking the November 28th expiration date, that makes the length of this option contract 7 days. Now with $22.50 as my strike price, I need to reserve enough money to purchase 100 shares at that strike price. So we take the $22.50, multiply it by the 100 shares. That means I have to have in my account reserved $2,250 just in case this option gets exercised and the shares get assigned to me. Remember, they get sold to me, and I have money immediately set aside to specifically so I could purchase those shares. So that's $2,250 reserved in my account so I can purchase these shares sometime during today when I sold the option contract and the expiration date. Now, based off of my strike price of $22.50, that's obviously below the current market price, and it's $2.84 below. So I'm already getting a savings off of shares that I want. I'm not going to pay the $25.34 per share. I'm going to pay $22.50 per share. That makes more sense to me. I like those shares. I like the company, and I especially like the share that I can get the shares at that particular price. And that means I'm going to be saving $2.73 off the current market price. So that's an immediate discount of just over 10%, 10.82% actually. Now, for selling the cash secure put, remember, I'm going to get paid a premium of 31 cents per share. In other words, I'm going to get $31 as the premium payment paid to me, and that'll get credited immediately to my trading account when this option sells. And that money is mine to keep forever. So I can withdraw it and use it to buy gas for my car. I can go out and buy dinner, or I can keep it in my account and use it for another trade immediately from day one. So as soon as I get it, that money's mine to keep forever. And that money, that $31, well, that represents a 1.38% return on my investment, right? So I'm investing $2,250, right? I'm setting that aside. And for doing that, for this 1 week period, I'm receiving $31 as the premium payment. And so that $31, that's how I compute that I'm getting a return on my investment of 1.38%. Let's take a quick look at my transaction history, and you can see here where I sold a cash secure put for symbol SOFI with an expiration date of 11/28, November the 28th. Now I did it this morning, Friday, November the 21st at 9:52 a.m. Pacific time. And you can see that my option got filled, and I was paid 31 cents per share as the premium payment, meaning I received a total premium payment of $31. So now at this point, I just have to sit back and wait to see what happens with this option contract on the expiration date. Now, again, if the price dips down to my strike price or below, well, then I'm obligated to buy the shares, and I'll get those shares assigned to me, and I'll use the money that I have reserved to pay for them. Or it could be that the market price never reaches my strike price. Even if it goes down to $22.01, I'm not obligated to purchase those shares, and so this option contract will expire worthless. This is one of the easiest ways that I know of to make money on a regular basis is by selling cash secure put options every week on stocks that I find with opportunities just like this one. But if I do get assigned the shares, that's okay. I like the company, and I don't mind owning those shares at the price that I specified. But I'm going to turn around and immediately use those shares to sell a covered call, right? So I'm going to use those same shares that I get, if I get them. I'm going to use those same shares to sell a covered call. I'll collect more premium, and that'll be the second leg of the wheel strategy. So if that happens, I'll make another video to show you that next leg of the wheel strategy. Hey, I hope this video has been helpful for you. I've had a lot of fun making it. Even though I had to do it twice, this is my second attempt. So hopefully it all works. Keep your fingers crossed for me. I enjoyed this video. I can't wait to see you in the next one. Let's trade options.